you understand it. Here we are with the light volume opening bell, 28,000 shares. You can see that this is $1 wide. What are you taught to do? You're taught to get over here 10 cents above the bid, and you can see that low volume equity creates a very wide bid and ask on the opening bell. Look at this, was over $1 something a minute ago. The low is 9.20. He prints 9.20 because somebody threw off. They closed out at 11.40. That was a wholesale bid based on the fact that with the light volume equity, that was a wholesale bid. Look at how wide they are now, 1040 by 1210. So if you get that marked down entry, you would be the one that would be coming out selling at 1150 over here. Look at how the prints are coming in. There's only 4 contracts, but look at the lower side of how that mechanical process on that wholesale entry worked. Is by having the bids down there, they marked it down 220. And now, with that low volume, you're going to watch how the name trades, how the wide bid and ask is here, but over here on that put side, they marked it down. 480 by 590, and these are all weekly. Here, they're marking this put below the low of 690 by 860. This is a wholesale transaction. Notice the pricing structures are $1 wide, and if you can learn this, you will survive and be the king of getting this side wholesale and getting this side wholesale and selling into the rally. There's your high, there's your reversal. This is the wide bid and ask on an opening bell in 3 minutes on options, and how the option derivative market has changed. And if you don't have the skill of understanding how to get wholesale over here, and you pay up like these people, look at the high. They paid up, keep these bids down here. Right now the stock is pulling back. You put a bid out here at 470 and keep a 50-cent stop market. And this one here coming back, it's $1.50 wide, all on the opening bell. Look at here, the 585 call, but this side low was, if you had that lower bid and they hit you, well, then you're in. And then look at this side of the market. Watch the ask rise, and as the stock reverses on the put side, all done in 3 minutes. Look at how wide, meaning you would have to bid in at a lower price, like 630. See if he throws it. What would you do over here on $1 wide? Well, 860 is the low. You only got 63,000 shares. It's all done in a 3-minute time period. You always got to go like 930. You're paying a premium to the low and the close, but you could create that print. We made a low, and that's one of our guys right here at 860 that got hit. Who was it? Here's how fast the calls bounce. Within milliseconds, we had that drop down support level, and we have bounced almost $4 on that light volume trade, whether you like it or not. And that wholesale market was made down there, and that was a ton of money. 730 by 820 on the entry over on the call side. And it all happened within milliseconds. Low volume. How do I trade low volume? I keep my bid down over here. When they drop it down to support and then it rips the other way, you get your transaction. Mr. Flag. Wide bid and ask. How to bid both sides of the market based on that low. That was the high. They came down, he hit the low. They popped it. They brought these down. They're positive 30 cents. 71 closed at 770. Still a premium to the close. Markets were made below it when that thing popped. And with the lower bid there, they taken that premium below the market. So I'm going to bid 730 over here. Why not? I'm not going higher. If I'm not going to break higher, as long as I'm below that bid and I get hit, I've taken the risk entry out of my trade, period. And that's what a market maker does. And that's how you steal the bid and then sell it over here on the ask. On both sides, within that trend structure. And if you can only work one at a time, well, hey, what can I say? You should be bidding below the market. That's $1 below there. And it was just at 730. And this is live right now. 6 minutes on the open. 6 minutes. That's $1 below it. And if this thing here doesn't go higher, You need to be hit. Somebody contracted it, got hit at $8. You throw it out there at $7.70 on one contract. You're buying below the low. You're buying below the $8.40. You're taking the risk out on the entry. That way, if you do apply a stop market, it's very minimal. Same thing over here. They paid well. Now they're down. Watch the trend. The last print, $9 print that could have been owned. Now the bid and the ask is $2 and something above it when you hit the bottom on the opening bell. Over here, as they whip that thing up from being oversold short term on light volume. How do I trade light volume? And how do I work these markets? Look at how these sides each worked. Now as we move through the day, these balances will balance out at some point. But the call side is definitely the one working, not by much. That's your high on low volume. And as I said, you can walk these things. These things have been marked down royally. If I put all of these into a chart and you could see how wholesale they were, you would know what I'm talking about. The thing about this side of it now is we made the high here. We made the high here. And so it's 580. It hit a number of highs on that opening print. You had 34 highs, 12 lows in the name. And it all happened in 12 minutes of squaring that initial intraday low and that high, capping both sides of this market with premium, and not to mention that with the very light volume that the option derivative markets have changed. And so they do business differently, and people just don't know how these markets work anymore as far as pricing control goes. Is you mark this side of the market down, you're not getting much of a markup, but you are getting some, and you are getting a little bit here. This side, which was marked up yesterday, they're just marking this side back down to where the original lows were the previous day, and they went up to $12.40 a contract. As these keep coming down to wholesale values and whatnot, once again, if you don't make a series of any more highs, if you make more highs, then this side will go down in value. Okay, it's the pullback in here that you want to look at with that volume trade and where the bid and the ask are holding on both sides. I'm going to conclude the opening bell. Happy Thanksgiving. This is how they drop that bid momentarily. You have 37 highs. More highs are being made. This side of the market's holding the bid. It was marked down the most. And boy, was it marked down. See, this closed at 1140. They're barely above it. But look at how wide the bid and ask is, and learning the technique of getting that wholesale bid and working with that entry. This one was 390. It's got some leverage up. And right now, we're making more higher highs. And we're about into the first 15-minute bell of the Happy Thanksgiving trade with very low volume. And you can see here that Apple is up $5. It's finally working because I got to cover the shorts. And this is what I'm talking about. You hit 365. This is what I was talking about. They do come around, and these will make higher highs, and these markets are going to go higher. These markets were marked down. That means when they do pull back today, and they do pull back, they made a high of 880, up 80 cents from the close. They're not much above the close to the bid. Understanding where that close was is that these things can go higher with this making higher highs. And it's still a little bit of a premium to the close, but you can learn that the wholesale bid was marked down to $9. It's $11.70 by $12.40, but it was marked down to that $9 area, and I've got the caption. That was the print. That was wholesale entry based on that hitting the low. That is the mechanics of understanding how to get the entry on the call and how the highs on the opening bell in a 15-minute candle have hit 43 to 12 ratio, which is positive. Look for when it pulls back. I've got people selling these contracts. into the highs. So you're okay there. Don't worry about that. We'll have our other bigger traders exit. So there is the opening bell in 16 minutes, and you made a series of 43 to 12 highs, and you're approaching that high. That means they're going to continue to market this side down in the first 15 minutes of the opening bell. You're not getting a lot of premium here to where it's the bid is 840 and the close is 770. If this thing wants to see, because they're still in premium over here. So if this thing does break these series and goes up considerably more in the higher high structure on low volume, you could end up with a move like Apple Computer. And this is that price action volatility, folks. And this is another round of buying in Apple that people are going to chase performance. They found a bid here, and they found a bid the other day when I said it would come down close to 365. So it's $9 up off of that bottom from yesterday. All right? And there's that market. There's that bid. There's the ask. There's the trend. And that's how they made this part of the range. Notice that the bid and ask isn't nearly as wide. But how do I get hit? How do I even get in? Well, we teach you that. Keep that lower bid down there. You get hit, you got a profit. So you can mark to market that low entry and then be selling over here. Same thing. Watch your trend. Watch the highs. That's the Google trade. That's the light volume. Light volume, how option markets work. How option markets have changed in pricing. What is mark to market? Where are they taking the most premium out? They're taking more out of this side today. Yesterday they'd knocked this down, but notice on the upside move here, you got a bid of 8 and by 8.5, and you had a close of 770. You're not much above it. It's not like you've missed anything, but if you learn how to make that market with that lower bid on the opening bell, so you got something out there at 620. 620 is what I think I gave as an order entry. And we had people that got hit at 620. Don't worry about it, because we did right here, 620, and selling out. So there are trades that can be made very quickly. It's something that someone has to grow into, though. Watch your trend. Watch this wholesale side. They marked it down. They finally marked it down. They finally marked that 585 is in the money. It got right to the 584.74. So this one's in the money. This one is out of the money. This one will trade different. Not much of a mark to market. A lesson on how to trade low volume. We'll feature the Apple trade. We are going to conclude that it's a holiday weekend and we're 20 minutes in the opening bell on both sides of the pricing controls. Okay, we can see the premiums that they've taken out of each market relative to the actual beta of the price movement from that low drop down to that high, from this high back to the current support levels. The fear indicator is continuing to fall, so people that choose to ignore that, that's why you're making higher highs from the mark to market and wholesale bids that were given out. And a boatload of money's already been made. Right there. 579 straight up to the top. Watch the top. Watch this side with that top. See what that does. Light volume. Look for that reversal. You are strong. You made 23 here. You're 21. You're 93 there. The fear indicators are down. You have extremely low volume. You were not here in the morning to get the analysis. You don't belong in any trade.